let's get started. David Finch will be joining me on stage, and I'm really excited to have him on. He's, as I said before in the introduction, he's a Paris-based fund manager, and you run a $240 million fund. And good morning, good afternoon to you. How are you?
Yeah, hi. Good afternoon from Paris, where it's been snowing today for the first time in a long time.
How have you been doing? How have you been holding up the last few days? How is your blood pressure?
Yeah, not too bad, not too bad. I guess the markets have been kind of tricky since August, really, directionally. But yeah, we've managed to keep our end up, and we've been outperforming our benchmark pretty much most months. So, but it's it's harder work than it is when everything's going up. That's for sure.
Oh, of course, you got a lot more due diligence. But before we dive into more detailed discussion as well, give us a bit of background on Ixios Asset Management, and also who's David Finch. Tell us a bit more about yourself.
Okay, so I was a generalist investor in Europe for, I guess, 25 years, and I also did a bit of global. So I really started looking at the gold sector back in 2015, and I was just doing a valuation screening exercise for a global fund, and all these gold miners came churning out as incredibly cheap, and I'd kind of never looked at the sector before, because other than in the UK, there aren't really any gold miners quoted in continental Europe, so it was off my radar. And I started to look at them and trying to work out why they've just gone down anywhere between 70 and 90%, in the last 5 years. And that's what kind of got me interested in the sector. And I ended up starting up an investment product at the beginning of 2016, which was focused mainly on large cap gold miners. And that worked very well. And so we converted that product into a European UCITS fund, a kind of equivalent of a mutual fund, in the middle of 2019. But to do that, for regulatory reasons, we had to create a new fund management company, which was Ixios.
Okay, you're really active on Twitter as well. I really like that. And make sure if you're watching to follow David on Twitter as well. You're sharing some of the commentary. You've recently talked about the silver price. We're going to get to your opinion on that silver price, but my point is, like, you're more of an activist investor almost, right? Like, fund managers who are active on Twitter is a bit of a rare sight, in my opinion, especially in the gold price. They're usually more laid back. So your opinions there are really appreciated there. How did your Twitter experience sort of feed into your fund performance last year? Let's talk about your fund performance and your experience with the Twitter space then second.
Okay. Well, we had a good year last year. You probably know that, well, our benchmark is the GDX, the underlying index of the GDX. So for practical purposes, it's the GDX, because that's the kind of alternative that most clients have to invest in the sector versus active funds. So the GDX was a bit disappointing last year. It was up 23%, whereas the price of physical gold was up 24%. So you didn't really get any leverage. We had a good performance. The fund was up 48% last year, and that was largely down to, well, I suppose 2/3 of the outperformance that we had was down to, I would say, mid and small cap stocks in the portfolio.
Yeah, I was going to ask you about the ratio of your portfolio compilation there a bit, right?
About 70% of the portfolio invested in large cap gold miners. I mean large cap in so members of our benchmark index, stocks that are in the GDX. Those are pretty concentrated positions. There's 50 stocks in the GDX, and I think we've got 11 positions in large cap stocks. And then we have, about 35% of the fund invested in stocks which are outside the GDX, small producers, developers, and explorers. And I think Twitter is a good place. There are so many small companies. I think there's over 2,000 mining companies listed in Canada and Australia, most of them precious metals. And just working, you can't work your way through all of them. So it's really good on Twitter. Somebody comes up and talks about something enthusiastically, and you're not going to buy it because somebody's spoken about it, but it may get you to contact the management, do some research, and take a closer look. So Yeah.
No, that makes a lot of sense. I get a couple ideas there as well. And it's good to see, because you see names you don't usually see, right? And then let's talk about that as well, because Twitter also talks about penny stocks, right? It's not just the Barracks of the world that are being discussed, obviously. So what can your fund actually invest in? Like, and how commodity agnostic are you?
Well, it's a precious metals fund, right?
Okay,
So,
just pure precious metals. Okay.
yeah, so we can do gold, silver, we can do a bit of platinum, palladium, because they technically, for some reason, although they're mainly industrial, they do count as precious metals. So
They're shiny.
yeah, they're shiny. They're shiny, they're expensive. Yeah, and occasionally we get a bit of exposure to some other commodities. We have a silver miner that produces a lot of zinc and lead, or a gold miner that produces some copper on the side. So, but we couldn't own a pure copper miner, for instance.
And what's the interest right now in your fund? I'm trying to get a sense of the overall market, right? We've seen a lot of activity the last 10 days, obviously in the silver space, but have you seen that translate into anything actually? Like, how real was it for you in that regard? Like, has the fund seen inflows?
We have since the beginning of the year, actually, although, ours is, our fund is available to retail investors across Europe, including in Germany, but we haven't actively marketed it to retail investors. So most of our guys are small institutions, private wealth managers, family offices, small private banks, and we have seen inflows actually since the beginning of the year. We've had a couple of good tickets come in. We've also seen some outflows as well. On balance, I think we've collected, I don't know, 5 or 6 million. But as always, and this is the problem of running a mutual fund, is you have daily liquidity. People can come in and come out. You get to 6 o'clock in the evening and you suddenly see you've got to raise $3 million the next day, right? So you've got to sell something, and you may have to sell things that you don't want to sell because you think they're really cheap. So yeah, I mean, right at the bottom a couple of days ago, somebody took out 3 million from the fund, and I had to sell some things that I really didn't want to sell, but you got to give them their money back when they want it. So
yeah, run us a bit through your stock selection process there, actually, because what you're saying, it also comes down to liquidity of those stocks as well, right? Yeah. So, like, how do you actually select a certain stock? And I know you attend a lot of the junior mining conferences as well. Yeah. So I'm trying to figure out, like, how far down the value chain do you go, and how do you actually find a good stock?
Okay, so we'll go down to really quite small things. I think our smallest market cap is about 25 million. But that will be a small position, obviously, because theoretically everyone could turn up tomorrow and ask for their money back, and we'd have to be able to give it to them, right? So hopefully that won't happen, but you have to have that in the back of your mind. So in a large cap stock, we'd have a position of 10, 12, 15 million dollars. In a small cap stock, we might have a position as small as $200,000 or $300,000. So we have to keep an eye on the liquidity, however much we like the stock. And it has happened to us that we've had to sell down some positions because they've got too big relative to liquidity.
That usually means that the performance was good, though.
It was good, yeah. So it kind of forces you to make some profits, right?
Right.
But yeah, our stock picking process is, I mean, we do have a formula, right, for large cap stocks, which we go through, which is derived from. It's basically to avoid the really badly performing stocks, right? So we spent a lot of time looking at what had gone wrong with gold miners in the past, and I think people don't really have this in mind, but if you look at the 25-year performance of gold and the 25-year performance of gold mining stocks, gold mining stocks have massively underperformed, right? Gold's up like 400% and the miners are up 50%. And, you look at any other sector, any other subsector of mining, and you can see that, they've all outperformed massively the price of the commodities that they mine. So that's something that's very special to the gold mining sector. So, our idea is to try and find the guys who are capable of offering decent leverage to the gold price over the medium term. I guess, we've got various filters about jurisdictional risk, about balance sheet, about position on the cost curve. But I think the most important one is management's attitude to capital allocation, because that's what's really destroyed value in this sector over the past is either acquisitions or new project builds which have been taken, decisions which have been taken right at the top of the market when gold was high and the companies were awash with cash, and they make investments right at the top of the market, and then at the bottom of the market when things are cheap, they may even be forced sellers like Barrick was in 2015 because they've taken on debt as well, and the banks are putting them under pressure. So we really look for companies that are capable of self-financing their growth, or where they need exterior finance, where they've got a track record of timing that properly and not using crazy gold price assumptions to justify their investments. So we spend a lot of time in talking to management about not about operational issues in mines, but about what their attitude is to development and development spending.
Yeah, there's actually a lot to unpack in what you just said, actually. A lot of facets, like why have the gold miners underperformed? I think debt, as you said, capital allocation was a big issue. Debt issues that have been resolved now mostly. Like yes, some of the miners still have debt. You always have financing costs, OPEX costs, sustaining capital. So that's normal. But some of them, like as you said, Barrick, for example, were just way over like leveraged. Like they had way too much debt on the balance sheet. They had to sell assets. Do you see, like, as a follow-up to that, actually, is that maybe a reason why we haven't seen so much M&A? Has the gold price run up too fast? Like now they're worried that they're buying at the top to repeat those mistakes?
I think, to be honest, when you look in the past, all the cash generated in the good times was systematically reinvested, mostly at the top, because that's when there was the most cash around, right? Yeah. So, if you constantly reinvest everything at the top and you don't return anything to shareholders, then you're going to end up, buying high and selling low systematically and never distributing any of your profits. And that's why the sector's underperformed gold in the long term. I think that what's happened now is that there's been a kind of generational change in the managements of the major gold companies, and everybody's got the new religion of capital allocation. So, and you look at the ambitions of companies like Newmont now, they've abandoned any aspiration to grow production. They're looking to maintain production, cut costs, and return the benefit of that to shareholders through dividend increases or through share buybacks. And I think the whole of the sector is now saying that this is what they're going to do. I think that's great. I think nobody in the generalist world believes them. And, I think it's not kind of 1 year of good behavior that wipes out 25 years of bad behavior. I think there's further to go before people are convinced that these companies are not going to go back to their bad old ways. And I think that is really putting downward pressure on M&A. So the M&A you've seen has either been big companies buying really small companies, where it's not an issue because the amount involved is so small, like Yamana buying the assets from Monet Gold, or Agnico buying thematic. These are very small tickets in the context of these companies. Or you're seeing nil premium mergers of the large companies like Northern Star and Saracen, I think that's and that actually feeds through to what we look for in junior companies, because I think that in previous cycles, a lot of junior companies focused on drilling off as many ounces as possible, and then either waiting for someone to come along and buy it, or proactively seeking someone to buy it from them. And I think that and that was plan A, right? And plan B was, I suppose if nobody actually turns up, we might have to build a mine, right? And I think that's switched around now. So plan A needs to be, we're going to build this thing. And plan B is, well, if somebody turns up and offers us a fantastic price, then we'll think about it, right? And some juniors have really embraced that transition. and are really moving towards production, and some haven't, right? And that's something that we kind of, we look at and we talk to management about and try and work out, what
Yeah.
they're.
That's an actually interesting comment, because a lot of the CEOs, or quite a few CEOs, are actually geologists, right? So they're not engineers, they're not mine builders, they don't have that expertise, right? Their expertise is drilling holes and finding ounces, right? So they do rely on the next guy to actually build it.
Sure,
right?
And there's nothing wrong with that, and providing that they realize that actually they still need to have a plan to build the mine, and they need to be prepared to either step aside or hire the right guys who are capable of doing it. And there are companies that that are doing that. So I think it's. There's nothing wrong with geologists running an exploration company, for God's sake. I mean, they're the best qualified people to do it. It's just that transition, which can be politically and personally difficult. Yeah.
And you made an interesting comment before as well. You like companies that self-finance or self-fund to grow as well. So do you actually like those explorers that say, okay, we're going to start at 20,000 ounce production or 15,000 ounce or even smaller sometimes production scenario to fund exploration? Is that something then you focus on?
Yeah, absolutely. And the biggest holding in our fund today is K92, which has grown to be the biggest holding, and that's exactly what they've done, right? They haven't come rattling the tin asking for more money to drill more holes. They've generated the cash to do it themselves, and not everybody can do that, right? It depends on the scale of your project and what the geology is and everything, but that's a fantastic thing to offer for shareholders, is lots of exploration upside, and we're never going to put our hand in your pocket. Right?
Yeah, and you'd ideally pay a dividend as well at some point, right? But
yeah, once you get into production, but you can't fill a portfolio with those kind of companies. There's not enough of them around, right? So, but we do look for a strong impetus towards production. And Minera Alamos, which is another one of our holdings, that's really, they're really moving forward. They're not tier one assets. They're not the best geological assets on the planet, but they've got a plan. They're going to build the mine. They're going to get the gold out. They're going to use that to finance the next one, and hopefully at some stage give some money back to shareholders. And that's their plan. They've told everybody that's their plan, and that's what they're doing, right? And you can't ask more than that.
Yeah, no, exactly. And full disclaimer, we're shareholders of Minera Alamos. So, yeah, I'm a happy shareholder. I bought it 13 cents.
Yeah.
No, and how do you see the current valuation? Actually, let's talk about the large caps for a second and develop, because the price to cash flow ratio for some of them is absurdly low. The generalists have not caught on, right? How do you see that developing? Like, what's your feeling there?
You've now got the yield on the sector has gone above the yield on the S&P 500 for like the first time, I think, since the 1930s. You've got the sector yields about 2.3%, and the S&P yields 1.5. I've never seen that before. You've got free cash flow yields anywhere between 8 and 25%. There's a broad range depending on how much they're reinvesting in growth. But these are extraordinary free cash flow yields for, I mean, they're good in the context of any mining activity. And as I say, I think that, obviously the gold mining funds in the world can spend their time shifting around holdings between each other, and maybe we get a bit of inflows, and that's not going to re-rate the sector. You really need the generalist money to come in to re-rate the sector. It's a small sector. It's 400 billion in market cap, which is tiny in the context of global equity markets, and it's got this dodgy reputation. There's a whole generation of fund managers who've lost money in this sector before and who've said never again, right? So, and that explains, I think, in a large part why it's so incredibly cheap.
Do you see a trigger? Like, what could be a trigger to get the generalist money flowing into our sector?
Well, the obvious trigger, obviously, is the gold price, does a Bitcoin or whatever, and goes up in a very aggressive and very visible way. I mean, that's worked in the past to get generalist money in. But I see it more as a kind of, and this is not a fantastically optimistic message to have, but I think it may take 2 or 3 or 4 years of good behavior by the gold mining companies in terms of capital allocation, in terms of dividend policy, to really get generalists back on board and to wipe out the memory of the stuff that happened in the past.
I'm going to squeeze you now for a couple top picks before we switch over to a bit of Q&A as well for a couple minutes. So, what are your top picks in the sector? Let's talk large caps. Who do you have there as the front runner right now? And then let's talk juniors as well.
Yeah, so as I said, one of our largest holdings is K92. That's done very well already. I still think it's very cheap, but in the rotational way that the market works, if we have a strong rally in the gold price, people will be taking profits in that to buy something that hasn't done so well. But that's one of our bigger holdings. Alamos is one of our bigger holdings. I think in the context of a large cap gold miner that can actually grow production, they're in the right space. They've got the right kind of exploration assets, and the valuation remains incredibly reasonable. They've got lots of net cash on the balance sheet, plenty of optionality. So that's a big holding of ours. And Sibanye is another one which we own, which is platinum and palladium and rhodium. They just had some fantastic results, and I think that's it's just such an incredibly cheap stock. It's trading on about 3 times EV/EBITDA. Okay, a lot of the assets are in South Africa, which frightens a lot of people off, but that's,
more on the junior end. Who do you have there? You said you have companies with a market cap of $25 million, and since we're more junior mining focused here as well, like who's your front runner there?
All the ones that we own. So actually, one of the best performing stocks in our portfolio last year, which has now become a big position, even though we've had to sell some, it's still a big position, is Go Gold, which a lot of people talk about on Twitter now. Actually, we've held that since right from the start. Actually, back in 2016, we bought some of that when they just had the Parral tailings operation. That's been an amazing story, and we really like it. I mean, last year it went from 60 cents to $2.50. I think that's a $5 stock fairly soon. Tremendous exploration.
Yeah, Los Ricos is looking really strong out there. So their new asset.
Mineable. I mean, that's the thing. These guys, I don't think will build this mine, but they know they've got to sell it to somebody. But it's an easily mineable asset. A smaller one, which we like as well, which we've got a position in, which comes out of the same Halifax stable as Silver Tiger. That's a pure exploration story over an old mine. They've come up with some tremendous results so far, both very high-grade narrow vein and more disseminated mineralization. And I think there's a lot further to go on the size of the resource there. So, that's the kind of thing we'll have a small position in because it's,
liquidity is one thing. As you said, you have to liquidate. Actually, just a small to the liquidate part, $240 million funds. What's your timeline on having to liquidate? Is there something in your fund description that you have 2 weeks or so to liquidate?
Prudentially, we won't buy more than 5 days volume in a stock. Right, 5 days average volume. Yeah.
Great. We got a couple of questions in the chat, and I urge everybody to use the chat function as well. And I hope David stays on for a couple of seconds afterwards, or a couple of minutes afterwards as well, to answer some if we don't get to all of them. One of the questions is how is the recent interest of European or French investors toward your fund? Where's the main money coming from?
Yeah, well, about 60% of our money comes from French institutions and private wealth managers. So they've been very supportive. We're now embarking on marketing the fund to private wealth advisors as well. And being a French company based in France, I guess it's our prime target. But certainly French investors seem to be pretty positive on gold, and most private wealth managers have a significant allocation to gold and gold miners, I think.
Fantastic. David, we are out of time for our fireside chat. I really
Okay.
appreciate you joining us this morning, or this afternoon for you. So really appreciate it. We have some more questions actually in the chat that I didn't get a chance to get to.
Okay.
So maybe you could jump over into the chat and respond. That'd be fantastic.
Yeah, sure.
And yeah, follow David on Twitter. It's at DavidFI_. Is it one or two underscores? One. Okay. It looked so long. That's why. So make sure to follow him. Also very interesting takes on silver and other topics as well. So make sure to give David a follow. Really appreciate you joining us, David.